All right, today we're going deep. I'm going to walk you through my full trading checklist, how I frame macro positioning, confirm my market structure, and manage trades with a clear plan in hopes that you guys can do the same and learn to have a clear plan in the markets and your own checklist that gives you a clear edge in your trading. Most traders just look at a chart, but the chart is only the expression of what's happening underneath. So if you want to be consistently profitable, you need to align your technicals with your macro context. Let's break this down step by step. Before I ever open up a chart, I want to know which way the wind is blowing. That means building a macro bias. Bullish, bearish, neutral, just based on current conditions. The easiest way to do this is by hopping into Forex Factory and seeing what is going on for the current week, the next week, and even up to the next month. Basically, what I'm looking for is the results of current news events like FOMC, pending home sales. Are we hiking, holding, or cutting rates? For example, if FOMC came in pretty hot, that's kind of signaling that we're staying restrictive because inflation is still sticky. This usually means it's bearish for risk assets, but bullish for the dollar. But if inflation prints and is cooling, the Fed hints at cuts, that's a green light for gold, equities, and risk-on trades. The second thing I want to be watching for is inflation data. That can be the federal funds rate, core PCE, CPI, personal spending, income. If PCE came in hot, that tells me inflation pressure is easing and likely supportive for longs on gold or equities. The third thing is actually growth indicators. You can look at ISM manufacturing PMI, unemployment claims, GDP growth, and housing data. With something like PMI, if you come in under 50, it's a contraction, which usually favors rate cuts and gold longs. Strong PMI is more of an expansion, which means the Fed stays hawkish and it's a risk off setup. So for example, if you're putting all this together, FOMC came in cautious, core PCE cooled off, and ISM is dipping below 50, that's telling me risk assets could perform. So my bias shifts bullish on gold and equities. This is step one of how I know which side of the market that I want to be on. Now that I know what direction I want to trade, I want the chart to confirm that for me. And this is where the market structure checklist comes in for me. Now I'm using price action from September onward. I'm not really factoring in this October price action. Just in the case of this example, we're going to be doing this on US 500 on the 1 hour. So the first thing I want to see is trend confirmation. Are we printing higher highs? Are we printing higher lows? And you can very much see in this case, higher highs, higher high, higher high, higher high. And we can see very clear higher lows being made. So in something like this, I can very clearly see bullish market structure. We are printing higher highs, we're printing higher lows, and we are respecting those levels. So for me, I do like seeing key zones being respected and retested because I want to see if price will retest a broken structure level or a discount zone before entering a trade. So for me, it's not about chasing, it's more about letting price come to me. If I want to be taking longs, I want to see price respecting a level and then continuing higher. As you can see, this is not a break of structure right here when this low is broken. To me, this is the current swing low. So everything above this is fair game to continue taking longs. Anything below it is where I might start shifting looking for bearish moves. So in this case, we respected this zone and continued higher. Would there have been an entry off here? Possibly. You could have looked even higher for a range breakout type move where we broke the higher high, came above it, retested it, and continued higher. So again, I'm not chasing the breakout when price breaks above here because it would have come right back down to my entry price or even risk being stopped out depending on how risky the trade was. I'm letting price come back to me, tap me in, and continue up. After all, price action is a series of higher highs and higher lows. Yes, we might have a higher high that is very overextended, but that just means we're going to have an overextended lower high. So one of the biggest things in my trading checklist is only taking entries during sessions that matter. Timing is one of the biggest confluences for me to be able to take profitable trades. So with this, my move is then backed by volume. I only want entries during sessions that actually matter, like London or New York, which means around 3 a.m. to 4 a.m. or 9 a.m. to around noon. Once I align that with my macro catalyst, it's not random intraday noise anymore. In this case up here, this tapped in around 9 to 10 a.m. Eastern, which is New York session, which fueled that move even higher. So at this point, both sides of my checklist are lining up. My macro bias is bullish. Market structure is telling me and confirming that there are higher highs and a clear retest zone for an entry. And this is what I would execute on. Now, the hardest part about my checklist is the psychology portion of this because that is crucial. Once I have my setup, I have to trust it. And this is where most traders lose, not because their system is bad, because they interfere mid-trade. And I remind myself in this case that my edge will play out over a series of trades. One loss doesn't mean that I'm wrong. I obviously detached from outcome-based thinking and focused on the process of the execution and executing properly. The calmer that I am during the execution and the more data that I've collected with this, the stronger my edge becomes and the more confident I am in my positions. Finally, the last part of my checklist is trade management and looking decently far out. So when I'm in a trade, I have already seen what the bigger picture looks like. I've already mapped out where I believe the market will go days to even weeks ahead to help confirm my move. But the way I approach this is I mark my macro target zones where price should react if my bias is correct. And I know my invalidations where the narrative breaks down. So in a case like this, if price continued to come back down and started breaking these lows and started forming lower highs and lower lows, I would be very cautious and take my foot off the gas and start understanding why we're coming lower and try and see, are we in a complex pullback? Are we going to respect this zone? Are we going to rebound off of it or continue lower? And this is what gives me the confluences I need in trading, where I'm very relaxed and letting the market's moves come to me. In a case like this, if I miss the entry up here, this is still a zone of interest for me. And as you can see, we basically just wicked that again. There's always going to be opportunities for more trades. And this is what people have to understand. You're not always chasing a single move every single day. And that's what I'm trying to get at. One well-executed, thought-out trade is better than 5 half-ass executed, barely planned positions. My stop loss is always usually attached to the point of which the trade idea is wrong. I could have had my stop loss down here for a more of aggressive entry because this is the most recent low. If I was really going crazy, it could be at the swing low. It all depends on the macro setup, how long I want to be in this trade for. If this is a weekly to a month long trade, my stop loss is going to be so fat. Obviously, if I first see myself just being in a position for a couple days to up to a week, that's where I'll have a more aggressive stop loss. So while I'm in trade, I'm not thinking, should I close here? I'm thinking, is the macro narrative still valid? And that's when you can go back to something like Forex Factory, look at next week, or even the week after that, and understand what could get in the way of this trade. And that's how you can understand, well, I should be closing, or I should think about closing or moving my stops to BE, because there's actually a reason to do that. Not just because the market came down a little bit and now I'm starting to freak out. And that's how you stay in control even when the market moves very fast. You've already done the thinking before you've entered. Now you're just maintaining. So to recap this, to start, always make sure your macro sentiment is on point. Understand why the market is moving. Once that's completed, move into starting to frame your market structure. When your market structure shows you that it is ready to follow your macro bias, that's when you will start thinking about entering a position. Once the market has come back to you, you can take your position and let it ride out while staying very cautious of what is going to be happening over the next few weeks to even a month. That's my full trading checklist. Macro, structure, psychology, and management. Most people trade from a chart onward. I trade from the macro inward. So if you want to trade like a professional, please stop guessing and start framing. Remember that trades start long before the entry. If you guys found this helpful, make sure to subscribe and leave a thumbs up and put any comments you have in the comment section. We'll see you in the next one.